I'm Charlotte McLeod with investingnews.com, and here today with me is independent macro strategist Tom Bradshaw. Thank you so much for being here. Great to have you.
It's brilliant to be on, Charlotte, and thanks very much. And looking forward to discussing this really volatile and amazing macro environment that we're living in.
Me as well. We've got so much to go over today. I thought, since it's our first time talking, if you wouldn't mind beginning with a brief introduction to yourself and your work, just so we can get to know you a little bit.
Absolutely, yes. So I've been doing this around 18 months, and I've been posting regularly on LinkedIn, where I provide macro and market insights for anyone that follows me there. And I'm also on Substack, so I deliver a fortnightly Substack newsletter where I go into more depth on these macro and market themes. And a lot of my work's based on precious metals and commodities in general, because I do believe we're in a commodity super cycle, and I think that started back in 2019. And I think this is a really, I mean, what got me into this was just the fact that I think this is just a great opportunity for investors to be leveraged to commodities. And I think sometimes in the mainstream media, a lot of people talk about equities and bonds, the sort of 60-40, the classic 60-40, but actually commodities are such a kind of underappreciated area of the market. So part of the reason I've got into this is I really do see an opportunity for people who can see beyond the headlines to potentially make significant money and, more importantly, protect their money moving forward in their lives.
Well, thank you for that introduction. We've got a lot of compelling directions to go in today. And where I thought we could begin is with that macro outlook. I know in a recent post, you had written about how oil and gold are combining to give us a signal about what's happening in the U.S. economy right now. So I wondered if you could talk about what you're seeing and when we've seen that signal before.
Yes, so basically, I got this indicator, which is which I found a few weeks back, and actually, this looks at gold and oil. So it looks at the inflation-adjusted gold and oil prices relative to their 12-month averages. Now, I've used the average of these two, and what I found is when they top 22%, we've always seen severe periods of economic turmoil, going back to the start of the fiat currency era. And so the first signal was triggered in around 1974, and this happened around the time of the 1973 to 75 recession, which saw a 4.9% fall in real GDP, which was the deepest that we had seen since the Great Depression. We saw this signal trigger in 1979, and this culminated in the 1980 to 82 double dip recession, where unemployment rose to 10.8%, which was the highest level since the Great Depression. And we saw this indicator again spike above 22% in 2008. And this was only a few months before Lehman Brothers collapsed. And the 2007 to 9 Great Recession saw the recession itself last around 18 months, which was the longest recession that we've seen since the Great Depression at that time. And what's amazing is this chart has now just triggered in March. And I think, I mean, what we've seen is a lot of sort of narratives going by that the market's sort of going to be fine. Investors are going to see off this sort of geopolitical issues in the Middle East and these sort of financial credit issues. But considering this indicator only occurs before the deepest and most severe recessions, it really is quite mind blowing that we have just triggered it recently. And the most significant thing about this indicator is that gold and oil are rising together. And that shows, gold rising shows that investors are pricing in financial and economic risk, and oil rising shows that investors are pricing in geopolitical risk. And when you have three of these issues existing simultaneously, it definitely shows that you've got, a lot of problems potentially on the horizon. And that's why this indicator has obviously been so effective in the past, and it's definitely an area to monitor moving forward.
I wonder if you can talk a little bit more about your economic outlook and what you see coming, because of course, the indicator that you're looking at has pointed to some of very, very severe events in the past. I've heard people talking about recession, stagflation. How would you characterize what you see coming this time around? Because it sounds like it could end up being worse than that.
Yes, so at the moment we are in a sort of stagflationary environment. Growth in the US is weakening, and we're seeing obviously inflation ticking up with the oil price shock feeding through now. But I think moving forward, I think we're in a very similar situation to 2008. In the first half of 2008, oil was on a rapid rise. And what we saw in the second half is oil plunged, the price moved significantly lower, but we saw severe economic turmoil from this sort of inflationary wave that sort of hurt consumers, hurt businesses, and caused a big drop in economic activity. So I think a stagflationary environment will probably move into a kind of deflationary sort of recessionary environment, sort of second half of this year, potentially. That's my sort of, that's my sort of outlook that I'm looking at, because I just think it's, there is this sort of element of, inflationary can be deflationary at the end of the day, because there's a lot of, consumers have only got a certain amount of money to spend. And if prices keep going up, then eventually they lose all their savings. And, the only way things really resolve is for prices to fall and for there to be waves of job losses and potentially a lot of much lower asset prices, particularly in risk on assets such as stocks and crypto.
That's very interesting, because I think right now, especially with oil price volatility and the higher oil prices that we've seen recently, it's really inflation that's the concern right now and not the deflation. So I wonder if you can talk a little bit more about that, and perhaps in the context of your longer term oil price outlook, which I know is a lot higher than we're seeing oil prices today.
Yes, so it is. I mean, to me, it's pretty. It's a very underappreciated area of economics. The idea that you can get inflationary impulses, but then you get disinflationary and even deflationary impulses sometimes. I mean, I remember, for example, going back to, the post World War I era, which is a long time ago, but we saw inflation in the US hit around 20%. In around 1920, and just a year or two later, we saw inflation bottom out at around minus 20%. So you can see big jumps in inflation followed by big deflationary shocks. Now, I know that was in a gold standard era, but it still does paint a picture that inflation can lead to deflation very quickly. And I suppose we've just seen, recently the highest inflation in 40 years. And what central banks tend to do in response to this is to tighten policy. And that can then cause a lot of disinflation, if not deflation, particularly when we have credit issues coming in, which seem to be happening now. But in terms of my oil price target, I'm really, really bullish long term on oil. Now, at the moment, we've obviously got all the issues in the Middle East, and oil is exceptionally volatile at the moment, with the price moving, sometimes $10, $20 in one day, which is just unheard of. I mean, particularly with what we've seen recently, where we've been sitting, I think late last year, we were sitting around sort of $55 to $60. And basically we've seen very small changes. The volatility just died down completely. But I could see oil potentially heading to $140, $150 back to all-time highs this year if the conflict escalates. So I think we could hit that sort of 2008 high. But I do at the same time think that that oil could be due some sort of correction once there's enough demand destruction in the system of the economy. And in terms of just talking about my chart that I've got here on oil, basically this goes back to 1861. So it's around 165 years that this chart goes back. And what's significant is I've drawn a channel, which is kind of a rainbow channel with depressed to bubble territory on oil. And what we've seen is whenever we've been in the depressed zone, we've always gone up to the bubble zone, then back to the depressed zone, and then back to the bubble zone. And we've done this continuously over the last 165 years. And we actually hit in 2020, when oil traded down at $20 a barrel, we actually hit the bottom level of depressed, the cheapest oil's ever been, as cheap as it was in 1931, which was during the Great Depression. And what we then have seen is a rise, but oil is still only at fair value based on the historical chart. So it's only at fair value. Even with the rise we've seen from 20 to around $90 today. And actually, the top of this chart does paint a picture. We could see $350 by 2029. And whilst I think sort of in the next, whilst I think we could go up to 150 in the next couple of months if the conflict gets worse, I do think we could then go down potentially as low as, $50 to $60 in that area, if there's enough demand destruction with the recession I'm forecasting, which I do think will be a severe recession based on the indicator, the gold and oil indicator I talked about earlier. I do think that actually beyond that, I think 2027 to 29, we could see a massive move in oil with all the money being printed, the reflation trade. Oil tends to do well after downturns. We saw this after COVID. We saw this after the Great Recession. So it really wouldn't surprise me at all if we saw oil make a huge move to the upside once demand starts re-emerging and we get this reflationary impulse. And this top channel line that we can see on the chart is actually, it's only been touched in 1980 and 2008, so those 2 years. And so it would be consistent with the post-fiat currency era that we hit the top of this channel, which we've done twice before. And it's worth noting that those were the two previous commodity super cycles that we were in, 1970 to 1980 and 1999, 2000 to 2008. That's sort of those were commodity super cycles. So considering I believe we're in one now, I really don't see 350 being a ridiculous target at all. And actually, in 1980, silver hit a high of around $50, $48. And oil was around 40. So the ratio between those two was around 1-for-1. And so a $350 target for oil would imply around a 1-for-1 relationship again with silver, which I believe will hit around 375 by 2028 as well.
I want to come back to that relationship between oil and silver because I think that's really important. But before we go there, for oil, I think that people are wondering right now, okay, how do I play this? And it sounds like from what you're saying, maybe the move in terms of getting involved in oil is to wait for this recession to happen. That's when you get in, and then we go up to those much higher prices that you're seeing. Is that how you would approach it, or is there more nuance to explore?
It's always a tricky one, in terms of how long you want to invest for, your time horizon, because, obviously swing traders might see opportunities in, over a day, over a week. But I think as a long-term investor, I think oil it's not elevated at these levels. I think accumulating oil today is definitely not a bad idea, but I think it's a situation where you probably want to get some exposure, but you also potentially want to sit in some cash as well, because if the indicator that I flagged with gold and oil, if that is proven to be correct, I do think oil could have, a lot lower to go down. And it's worth bearing in mind, in 2008, we saw around a 70% crash in oil. In COVID, we saw another big crash in oil. We saw a big crash after the Gulf War spike that we saw in the early 90s. So oil in recessions tends to really struggle. It's sort of before and after the recession, it does well. So I think it's sort of a situation where perhaps it's worth just stepping aside, but I still think allocating money to this sector is definitely worthwhile. And as we can see on the long-term grey line of this chart, we're only sitting in the fair value zone. So with a potential upside target of 350, even at current levels, we're talking about around a 4x move. But obviously personally, dollar cost averaging on any pullbacks is what I would say. But if you haven't got any allocation to the sector, it's always worth buying some oil now, I would say.
And are you able to talk about what your preferred vehicle would be for exposure? How would you look at it for oil?
Basically, so oil's tricky actually because you could only get you can't get sort of access really to the spot prices. So obviously with gold you've got the GLD, and silver you've got the SLV. And those actually those have underlying gold that the ETF holds, and they track the spot prices. With oil, it's USO is the best for WTI, the best ETF that you could get exposure to. Now that does track futures. And you have got an issue if the futures curve is in contango, because the futures obviously it's obviously front month futures, but they do roll forward. So you have a situation sometimes where you can basically lose. When the futures roll forward, they've got to buy futures at a higher price. So you do sometimes underperform the spot price of oil. Obviously the opposite's true if the curve's in backwardation. So a period like now where futures are actually trading at a discount to spot, it's actually quite a good time to be in USO in the ETF because you've actually got a situation where every time the futures are rolled forward, they're actually bought at a discount. So you're actually making money. So it obviously the futures does, there is a risk with that. Obviously it's very, no ETF can hold physical oil because of, obviously it's very, it's very tricky to do. But I do at the same time, I think that's the best one, that you can get access. And WTI tends to be a bit more, it tends to be quite volatile and actually potentially outperform Brent. But I mean, Brent's more of a global benchmark, but WTI can provide, more volatility and quicker gains. And it does trade relatively similarly to Brent, WTI anyway. But I definitely think USO is probably the best way to get access to play oil. And obviously equities as well. You can allocate to equities. I tend to be, personally, I'm very into physical commodities because I like access to the sort of physical price, because I think obviously equities are very good in terms of getting leverage to the underlying commodity. If you have, they tend to move after the spot price does of the underlying commodity. So you can be a little bit late and get into sort of energy equities when oil's already moved up. But I do the reason I like buying physical sort of, and getting access to the spot prices is I think what you have is a situation where you can get, you can benefit from supply being cut as well as demand being increased, because I think if you invest in a company where supply can drop, you have got a bit of a risk. The company can maybe not get the oil out the ground at the end of the day. Whereas with physical oil, you have got the benefit of, if supply drops off a cliff, you can actually make money with the price going up that way. So you've got both hits. You've got the demand and the supply side working together in your favor.
I understand what you're saying. I think that makes sense. Let's go back and look at that relationship between oil and silver. I believe you have another chart that shows the history going back quite a number of years. So I think that'll be interesting to look at in terms of the history and how that can tell us how that might develop.
Yes, so oil and silver have moved really, over 166 years this chart goes, and oil and silver have exhibited an 81% correlation over this period. And what's really significant is, just looking at this chart, it's just they track each other so closely. And if we sort of scroll forward to the start of the fiat currency era, what we can see is silver often moves ahead of oil. And which is what we saw in the early 1970s, in the late 1970s. We also saw this dynamic play out after the GFC in 2009 to 11, and we saw this after COVID as well. And in the sort of on the upper right hand corner of this chart, what we can see is silver has recently moved aggressively to the upside, and oil has only started to move over the last few months. So oil is playing catch up to what silver's done, which has happened several times in the past 55 years. And actually, where the chart sits today, it would imply basically, if oil was to catch up with silver, that we could see prices well in excess of $200. Now, I do think silver probably heads lower because it is 50% industrial, 50% precious. So I think the industrial side of silver will take a hit during a recession. But I do think at the same time, oil has got a big catch-up trade to play against silver, as we can see on this chart. And I think actually it's, right now it's kind of showing in a stealth way how much of a great buy it could be, in a few months' time, once the sort of recession's sort of underway and is kind of potentially losing its potency a bit.
I wonder, do you have any thoughts on why they track each other so closely? I know you're talking about how silver's got its industrial side. It also has its precious side. Any thoughts on that? I'm just curious.
It's a bit peculiar. I mean, it's basically, I mean, I've called the chart the dark dance, and to be honest, I'm very, I mean, it kind of perplexed me a bit that they move together, because one of them's a metal, precious metal, the other one's energy. I suppose there's kind of a necessity to both, because one of them is the whole energy system of the world. I mean, a third of the world's energy comes from oil at the moment, and it was 50% in the early 70s. Now it's around 33%. But oil is so important to our energy, and silver is so important to us in terms of it being real, tangible money. And silver's actually been recognized as money for, in some languages, it's still recognized as money, in terms of the definitions. So that's, I think that could be the correlation a bit, the idea that they're so important to us, but in a very different way. And this is, to be honest, what really blew my mind about this chart, was just the fact that we're taking two commodities that are both very important to us, but in really, very different ways, and we're bringing together a correlation which is just really amazing, amazingly high over such a long period.
It's definitely very interesting. And one more question on silver. So of course, people who follow silver know how volatile it can be. And if we're going to get back up to these higher prices for silver, I have to imagine we're going to see even higher levels of volatility. So I wonder what you see coming on that front, and any thoughts or advice you have on weathering that volatility in silver.
Yeah, silver's volatility is just amazing sometimes. I mean, it can be amazing in a good way, and then also in a bad way, depending on when you buy. But yeah, basically, I mean, as we've seen throughout history, in 1979, silver absolutely, second half of that year into early 1980, absolutely soared. It did the same after the Great Recession in sort of 2009 to 11. It went on a huge run. And it did it last year again. We saw a doubling of prices in only a few months, late last year into early this year. I think at one stage in January, we were up around 60-70% in the month before we saw the correction. And that was only 3 weeks we were up that much. So it is, silver tends to leave it very late, but tends to, get started and just absolutely explode. So it's an amazing commodity to hold, because you can just have years where nothing happens, and sometimes, but it can just suddenly just make transform your portfolio into, you can see some amazing numbers on your 401k and everything. But basically, so what I've got is a chart on silver that kind of maps out where the price could go moving forward, and I've got a very similar chart to the one I just showed on oil, from bubble to depressed. And again, what we've seen, this chart goes all the way back to 1802. So it's a very, very old chart, 200 plus years. And I've done a channel, and what's basically happened is every time we've hit the top of the channel, such as in 1864 and 1980, we've then hit the bottom of the channel in 1941 and 2001. And given that the last hit of this channel was the bottom in 2001, if history is any guide, the top of the channel is where we're heading now. And what was quite interesting is a couple of years ago, so after the pandemic, we actually we were sitting in the cheap zone. at that time. And this rally, so the recent rally we had in silver from 2024 into early this year, so that 2-year rally we saw from early 24 to early 26, took silver from the cheap zone all the way to the expensive zone. But with the recent sell-off we've seen, we've actually gone back into the fair value zone. So silver is no longer expensive. It's now cheaper. It's now sort of where it should be based on valuations. Now, I do think a recession will act as a headwind for silver. And I do think, given the fact that we have been recently in the expensive zone, I think there will be some profit taking. And I think there's also the element of the fact that, you know, investors there was quite a lot of euphoria at the beginning of the year, obviously with precious metals rallying so much towards the end of last year. So I think some potential retail money entered the market, and there were some weaker hands that entered looking for sort of quick money. But I think the long-term investors are definitely, I think there's a lot of long-term money in silver holding it up. So I think in a recession, we probably will see potentially prices falling back to around $50. But I think that's probably the floor, you know, $48 to $50. And those were the two highs we saw. So in 1980, we hit $48. 2011, we hit $50. And when you break out, I mean, actually, on this chart, you can just about make out a very nice cut between 1980 and 2011, and then a handle between 2011 and when we broke out last year in 2025. And that cup and handle pattern is so bullish, but over a 40 plus year period, it's absolutely mind blowing to see something like this appear on charts. But when you break out of a bullish pattern like this, you retest where you've broken out, but you don't then go below that level. You always hold the breakout. So I'm looking at $48 to $50 being a major sort of buy zone, potentially, with that potentially being the floor. But I do think we could go back down to those levels because of the severity of the recession I'm predicting. And I do think it's worth bearing in mind in 2008, silver corrected around 60%, and that was in a severe downturn. And I suppose, I mean, we were up at 120 at the peaks. So 120 to 50 implies around a 60% correction again. So it's kind of on par with what we saw in 2008. And I think with silver sitting at around sort of $80 odd today, I mean, it's done quite a lot of the correcting already. So I personally would potentially be accumulating dollar cost averaging in on any pullbacks that we see, because I think the lower silver goes, the more attractive it becomes. And even at $80 today, we're looking at almost a 5x move to 375. So I mean, and that's 2028. That's only a couple of years away, 2 to 3 years away. So it's massive upside, even where we are today. But from $50, that's 7-8x potentially.
I think that's great context on what you see coming for silver. So it could go lower, but we've got a floor. And what really matters is what comes after that recession that could be unfolding. Let's talk about what you see coming for gold as well. I know people have a lot of questions right now about what's going on with gold, especially since the start of the Iran war. People wondering, why did we see the price go down instead of up during a time of conflict? I know we're higher at the moment right now, but what do you see coming for gold? Is it a similar situation as silver, where in 2026 we could go down with the recession before we then see a much bigger move up?
Yes. So basically, on your point with the war, I mean, gold, there were so many people that were surprised that gold dropped as much as it did. I mean, it was down around 10% in March, which is a huge fall for gold. I think it was its worst month since October 2008, I think I saw. So, I mean, it hasn't happened for a long time that you saw that amount of weakness. And what I actually read into that, I mean, I did some research into this, and I found that it was actually the dollar strengthening which hurt gold in March. And it was also the fact that gold had got a little bit overvalued, but on my models, based on the fact that we'd had the massive move that we'd had up, we moved from around 2,000 in early 2024 up to 5,500 in early 26. So in 2 years, we'd moved, 100 175% up. So it was sort of profit taking and the stronger dollar that I saw for gold's decline last month. The combination of those two. It wasn't so much affected by yields from the research I did. It was more those two. But basically, with gold, I mean, I actually, compared to silver, it's around 90% precious, 10% industrial. So it's a lot more of a precious metal. So that will help gold hold up in a recession because there's that safe haven demand that will be there. But at the same time, investors will sell gold potentially, particularly during liquidity panics, because gold does provide liquidity. And there is this, if investors have made money in gold, particularly longer term investors who bought, 1, maybe 2 years ago, they'll probably want to sell gold because obviously it's a winning position and it does provide some money for them to potentially, deal with issues such as, over leveraging issues, potentially even personal financial issues. So gold could actually almost, its role of providing liquidity could hurt it a bit over the next sort of 6 months if we do see a recession. And I do have downside targets. I mean, we're sitting around, up towards 5,000 now, 4,800. But I do think we could see potentially a low of around 3,500 to 4,000. I don't think the bottom is necessarily in for gold yet, but at the same time, I think any drop below 4,000 will be quite short-lived. So I don't think gold's going to sort of go down to 3,500 to 4,000 and sit there for ages. I think it'll be a very quick drop because I think the only way we'll go down potentially as low as 3,500 is in a huge kind of liquidity crisis where investors are just kind of panic selling and sitting in cash and are very, very scared of everything. But at the same time, I mean, I think beyond that, I'm incredibly bullish, and I've actually got a target of $9,250 by 2028 for gold. And based on this chart that I've got here, I've actually looked at gold cup and handle patterns going back to 1969, and basically what we've seen is every breakout of these cup and handle patterns have seen gains of 345%, 346%, and 347%. So almost identical. And the cup and handles are 1969 to 71, 1974 to 1978, and 1996 to 2005. So these post cup and handle breakouts have been significant bullish periods for gold. And we saw a cup and handle develop in 2011 to 2024. And if we apply the same 346% gain again, or the average of the last three, which is that, we get a target of 9,250. And we're actually moving progressively towards that, with gold just continuing to climb. And what you'll notice is in the post 1996 to 2005 cup and handle breakout, we saw the Great Recession in the middle of that 347% gain. And I think we're in a similar position now where we'll see potentially some downside, but beyond that, another rally up to 9,250. So that's kind of my outlook really with gold. I think potentially a bit of downside over the next sort of 6 to 9 months, but 2027 to 28, we could see a huge rally. And from potentially 3,500 to 9,000, that implies well over 100% gain, 150% plus gain for gold.
I think it's always reassuring to look back on those past bull markets and see you can still have a pullback and remain in the bull market. So really useful to look at for gold. The other piece I was hoping we could fit in is the stock market. So we talked about how people were surprised to see gold go down during the war. I think people also surprised to see the stock market keep going up during a war. So I wonder what you see coming there. What do you make of that? And especially with the recession coming at some point, probably sooner than later, how do you think the stock market reacts?
Yes. So, I mean, the stock market's been on a tremendous, it's shown a tremendous amount of resilience, considering what's going on across the world. I mean, at the moment, we're seeing 11 million barrels roughly being lost a day, with what's going on in the Strait of Hormuz. And this includes, by the way, things like the emergency stockpiles and the Saudi east-west pipeline. This is net. 11,000 barrels are being lost a day. And that is around an 11% supply loss. And I did a model, and I've actually worked out that $100 oil only prices in, the market is only pricing in a 2% supply loss with oil at $100. An 11% supply loss would imply oil would be trading around $270 if that was realized in the oil market based on my research that I'd done. And a 9% supply loss, which I believe is more realistic moving forward. If we were to see some improvements in the pipelines and the stockpiles, if this did continue, would still apply around a $240 oil price. So that's, given that, the fact that oil's trading as low as it is definitely does show the market's pricing in, a resolution to this conflict. And I think a lot of it comes from the fact there are midterms coming up, and the market seems to think, Trump's going to pull sort of the rabbit out of the hat a bit with this conflict. Even though to me it looks like a situation where Iran have got control over the strait, which they're unlikely to want to relinquish easily, because it's a massive sort of bargaining chip. And obviously you don't, unless you get incredibly good terms in a negotiation, you're not going to give it up. So I'm quite gobsmacked that the market's gone up despite this, because I just can't, I think the S&P is up 3% since the beginning of the war, which is just unbelievable. And to me, there's just a huge amount of complacency that's crept into the market, because I think if we cast our minds back to any corrections the S&P's had going back to the start of this bull market in 2009, it's corrected several times. In 2018, it had that 20% drop at the end of the year, where the Fed raised rates, and Trump had that issue with Jerome Powell, that argument with Jerome Powell about raising rates, and the market, made its way to all-time highs very quickly after that. During COVID, we had another big drop, around 30%. And the market again had another V-shaped recovery all the way back up. And we then had 2022, highest inflation in 40 years. The market has another V-shaped recovery and goes back up to new highs. And then Liberation Day, Trump announces the tariffs, and the market again crashes around 25%, and then makes new all-time highs really quickly. And I think what's happened recently, we only dropped around 10% on the S&P, but we've actually made new all-time highs in about 10 days. We basically, I think the market was up 13% in around 13 days. So, for perspective, a decent year in the S&P is around a 10% gain. So in 13 days, investors made what they normally make in a year. So to me, it was just a most ridiculous move as far as I'm concerned. And I think a lot of it was to do with, there was sort of options. There were quite a lot of options expiring towards, because it was a period of those options expiration coming in. So I think there was some manipulation behind some of the shorts being squeezed out of the market, which is why the market rallied. But I think the market's almost got to a stage now where it's going to go up whatever happens. Even today you're seeing the market soften a bit, but oil's up, and we have got, the strait's still closed. It hasn't been, nothing's changed on that front, and the market's acting as if it has. And I think, we go back to the chart that I showed about with gold and oil. It's signaling one of the most severe recessions we've had since the Great Depression. And the market's acting as if nothing's happening, basically. And I think that's the major risk that I'm seeing. So I think it's probably one of the most high risk places to have money right now, based on the indicators that I'm seeing. And I do think, I obviously don't like to mention 1929, but I do think that does come to mind when I see this market, because it's run on debt. It's run on just euphoria. And I think what's happened in this cycle, which didn't happen so much in 29, is there's just this underlying view that the market can kind of climb the wall of worry and just go up, even if a lot is thrown at it. And I think that's my major concern with the market, really.
I think that is a concern that's definitely worth noting at the moment. I think we've gone through your overall thoughts on gold, silver, oil pretty well, risks that we should be aware of. Anything final that you would leave investors with to wrap all of this together? It sounds like the focus is really on having the physical commodities and getting prepared for the recession and what comes after.
Yes, so basically, I mean, just quickly going back to the S&P. I mean, I've got a final chart on the S&P to gold ratio, which I've done, which goes all the way back to 1921. And what we've seen is the ratios recently. So last year it broke below the 10-year moving average, and that's only happened 3 previous times in history: in 1931, 1971, and 2002. So, and it doesn't kind of imply that the S&P is in a bear market now. So even though the S&P is going up, it's worth bearing in mind when we price it in gold terms, it's actually going down because gold's been outperforming the S&P significantly. So I think for me, this is kind of a stealth bear market in a sense, because for investors that are in precious metals, they're seeing significantly bigger gains in their 401ks compared to people that are in the S&P 500. And I think, the fact that we've seen a signal trigger that triggered in 1971 when gold was trading around $40 and went to $875, a signal which triggered in 2002 when gold was trading around $300 and went up to $1,900, just around 9 years later. I actually think this is huge, and I think gold's in a huge cyclical bull market, and silver is very much in the same camp to that, and oil. And I think this whole AI trade has kind of held the market up for quite some time. But I think there's a lot of underlying weakness. I mean, there's not a lot of companies beyond AI that are actually doing very well. And as we've seen with the US, the non-farm payroll numbers, we've only averaged 20,000 jobs over the past 2 months. So it's 12 months, which is a very, very low number and historically very recessionary. So that's really those are my thoughts really. Just precious metals and oil are in big bull markets. We will get pullbacks, but the interesting thing is the market that's actually been very strong recently is the market I think is most at risk, which is US equities.
Yeah, I think that pulls it all together really nicely. So thank you so much for coming on to share your thoughts. This was great. I think it's very valuable for investors.
Thank you very much, Charlotte. I'm looking forward to being on hopefully in the future and discussing more. And thanks for having me on.
Yes, of course. We'll make sure to have you back soon. And for now, once again, I'm Charlotte McLeod with investingnews.com, and this is Tom Bradshaw.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.